If you started investing in the stock market around 2009, you probably look and feel like a genius right now. But here's the real question. Was it skill or was it staying simply in the game? Today, we're breaking down what the last 15 plus years in the market really teaches us and why consistency might be the most underrated strategy in wealth building. Andrew Parrillo is back. He's the founder of Parrillo Investors, and he helps individuals invest smarter and think differently about how wealth is actually built. And today we're having a real conversation about the stock market. What's happened since 2009, what people get wrong about it, and what it actually takes to benefit from it long term. So let's get into it. Andrew, thanks so much for being here.
Oh, good to be here. Thanks, Lisa.
Yeah, let's start here. I think because it's kind of funny. If someone started investing around 2009, they basically have experienced one of the best market runs in history. So, in your honest opinion, are they great investors or are they just great at being in the right place at the right time?
Both. They believe in themselves and they understand what can happen and and they've enjoyed a remarkable run in the stock market. And then what are the
Yeah.
numbers? So the numbers are that if you put a million, all right, I'm going to use some big numbers and you can divide them by 10 if you want, but anyway, $1 million in the stock market in March of 2009 would have grown to $12.5 million, or actually $12,600,000 through the end of February. Okay. And
Wow.
that was at 16.2% a year, I think it was. Is that going to continue? If it does, it'll probably be the first time ever that it's happened if it continues for the next 10 or 15 years. But it won't. But the point I'm trying to drive home here is that anybody that did that had the guts to be invested after that horrible bear market in 2008. And let's face it, it was scary. Anybody that was around then knew that, the whole system nearly failed and nobody believed that things were going to get better. And the news in March of 2009, when the market bottomed, the news was terrible on the economy. Everything just looked awful. But that was the time to be investing or to stay invested. And I know people who actually were scared out of the market by that point. They got out. And when did they get back in? I'm not sure they ever got back in. But if they did, it was much well after the bottom of the market. And so,
Wow.
if you don't get on the train, you're not going to get there.
Yeah. So how much of it is like in investing success is about timing versus just consistency?
Oh, it's absolutely consistency. There's zero question about that. It's not possible to time because again, if you were thinking, okay, let's just assume for the moment that you were really lucky or really smart and you got out in October of 2007, which is when that whole stock market decline started actually. And it accelerated. It was down 50% over the next year and a half almost. And all right, so you got out, they say, feeling pretty good about yourself. Okay, now what's going to happen? Was I just said, the bottom of the market occurred when the news of the world, the economy was just terrible, and business
Hmm.
profits, things were just terrible, and that was the time to be investing. So
Right.
if you could do that, if you know that you probably your emotions are going to be telling you to run, okay, away when you should actually be going towards risk. You should not be running away from it. So you almost have to do the opposite of what your emotions are going to tell you. And why do I say emotions? Because what I do is based on behavioral patterns, and that sounds kind of goofy, but I think people understand. People are about 2.5 times more concerned about losing money than they are about gains in their money. And so, there's basically, it's a human instinct to get away from things that are harmful. Okay. And
Hmm.
that certainly could be harmful. Losing a lot of your 50% of your money is definitely harmful. But if you can stay invested, you should do so. And if you could get invested, you should do it. And just know that your own emotions, you're probably going to be doing the opposite of what your emotions are telling you to do. And and so how the heck does this guy think he could help me with that? Well, I think there's a there's There's a device, really. It's a question. It's based on a Nobel Prize winning theory, prospect theory. It's on my website. It takes maybe 10 minutes to do the questionnaire, and it'll tell you not just what you would like to do, but it'll tell you more like really what you will do in those conditions. Because when people are making decisions in conditions of uncertainty, they can tend to make bad decisions. So it
Hmm.
really tests that situation. Is there a guarantee that it'll help you do that when things get ugly? No, but it'll give you a pretty darn good idea of what you should be doing and what your tolerance for risk really is. And that doesn't, and that's available on my website, which we can talk about later if you want, but you don't have to put an email in or any of that stuff. And it's a behavioral questionnaire. And I think it's based on again a Nobel Prize winning theory. And you say, yeah, that's just theory, that's not reality. Well, I can tell you for sure in my business career, investing, helping people, endowment funds and wealthy individuals invest their money, that is my reality. Okay. That theory works in practice.
Hmm. So like for the people who might not understand the way it works. So a lot of people try to jump in and out of the market. So what happens when someone pulls out of the market during a downturn?
Well, I mean, they're going to feel really good about it if they go out, if they get out before the market turns down. I mean, that could have happened this year. People could have said, "Hey, look, it's really done well. I'm going to get out," and they would have saved themselves some money because the market's down a little bit. It's not down a lot by any kind of historical standard. It's kind of a mini correction. It's not really a bear market, although in some stocks, to
Hmm.
certain technology stocks, it definitely is. But then on the other side, those technology stocks have been like a rocket ship to the moon, so they've done really well. But all right, so they're down.
Hmm.
But so I think what it does to people, if they want to try to get in and get out, you begin to question your own judgment when that happens. If you're wrong, okay, if you're right,
Right.
you're feeling pretty good about it. Yeah, I got into the spot. Well, okay, good for you. The probability of doing that correctly and consistency is pretty darn low, and maybe some people are capable of doing it. And my hat's off. Great. Then that's what they should do. But the vast majority of investors cannot do that, have shown a tendency to do the opposite of what they should have been doing, which is to say they've been selling instead of buying. Right? It's kind of like this has been around forever, I didn't make this up. Okay, I'm not reinventing the wheel. I'm just talking about theory that's been out there for a long time from some pretty successful people. Well, one of them is Warren Buffett, of course. And it's when he says when people are greedy, you should be fearful, and people are fearful, you should be greedy. And that's pretty good advice. Now that's at the extremes, of course, but where people display greed and fear, but it's always there under the surface. It's always ready to manifest itself. But what's going to happen if you try to engage in that game is you could very well be just second guessing yourself forever. And hey, if it makes you feel good, do it. But but I'm not sure it's going to make you feel good.
Right, right. So, Andrew, I'm curious, when we look over the past 15 plus years, what should people actually take away from the trends that have been happening?
Well, think about what's happened in the last 16 years. So, okay. And especially in the last few years, we've seen some changes in our world. We've seen, we've experienced, unfortunately, 6 years ago, we experienced the pandemic, which was horrible. It was scary. And and that's the last kind of market correction, real correction we had. I mean, we had one last April when the tariffs came into play, but then that was over with fast. But in March or February of 2020, the market went down 35% in 30 days. In 6 months, it came back in 6 months. Okay. But it went down a lot really fast. And so we've come back from that. So what did that teach us? Well, it teaches us, I think it teaches us that there's a lot of resiliency in human behavior, is that we didn't want to sit around hunkered down with limited supply chains and limited availability of services, and having to quarantine ourselves if we had an infection or what have you. We've lived through that. That was pretty terrible. What else has happened in the last 16 years? Well, more recently, we've had some pretty scary stuff happen with in Iran right now, and with the price of oil, the price of gas, everybody sees the price of gas. It's gone up from, a lot. And unfortunately, it sure seems like it could be higher for longer, higher than it is now for longer than we want. And maybe it'll come right back down, but and I sure hope it does, because there's really plenty of oil around. It's just that it has to get to the end user, and that's the problem with what's going on now with this conflict in Iran. But so think about that, and are we going to be able to get through it? Will inflation tick up a bit? And inflation's been, after the initial bump in inflation from COVID, when the supply chains were limited, and inflation went up to 7 or 8% rates for a short period of time. And the government responded in 2022, and they raised interest rates, and inflation actually slowly came down to the point where it's around 2% a year now. Maybe it was a little less before this conflict, which is, maybe manageable. It's still high. Even 2% is high. But is that going to go up? Yeah, it might go up. Probably. Well, it's already gone up. We could see it in the price of gas, and that gets filtered into every price: transportation, diesel fuel, you name it. It goes up. Think of, where do we stand? Well, we've made it through some pretty ugly situations in the last 15 years, and the market's done really well. Oh, by the way, we also have this thing called AI. And many people may dismiss it as being goofy, and I won't let a computer make a decision for me, and garbage in, garbage out. I don't trust it. It's not that. Well, I can tell you right now that it's profoundly changing the way business is being done.
Mhm.
Okay. It definitely is. And the people that know that probably most directly are the programmers, people who do computer programming, because it's hit that industry really hard. Because one of the Anthropic has something called Claude, which is an AI device or program, and it's actually programming itself now. They don't even need programmers it programs itself. And so that's happening. Is that good for society or bad for society? You can say whatever you want about, oh my God, it's going to be the end of the world and computers are going to kill us, and they're going to be out of control. Maybe, but it's kind of like any other tool. It's a super powerful device to help people do things more efficiently, much faster, and for way, way less money. I mean, I tell you right straight out to your audience here. I mean, when I had my firm, and we did investment research, okay, and the people that I had working with me did a lot of spreadsheet work and analysis, and I mean, I literally was paying people six-figure salaries for what could be done right now in like an hour for $20 a month using Claude AI, and that's a fact. So you go from paying people six figures to having to pay them essentially not needing them at all, because you can do it yourself in a matter of minutes. Um, that's reality. That is the way the world is going to go, and we'll be more productive. It's going to mean job losses. It's going to mean dislocations of people. Um, it's going to mean a lot of things. There's so many implications for it, but it's kind of almost like that 30 years ago the internet started, and people, I don't trust it. I don't. Now most people use the internet every day, for one thing or
Mm.
another, and has it made our lives better? Yeah, I think it has. I mean, if it didn't, people wouldn't be using it. And I think that's what's going to happen with AI. Will there be problems? Yes. Are we in an AI bubble? You hear that all the time from the investment people, and the the financial news networks are, we're in a bubble. Oh, we're not in a bubble. We are in a bubble. I don't know, but I do know this, that it's things tend to go to extremes. Our data center is going to use all the electricity that we need in the world. No, I don't think so, but they're definitely using a lot of it. Our data center is going to be harmful to the environment. Well, maybe, but and so where they're located makes a big difference, and they're all over the place now, and they're building more of them. So, is there a bubble there? Is it going to be harmful to us? I don't know. Is the automobile harmful to us over the last 120 years? I don't think so. Maybe it has been to some people, but I don't think so. Has air travel been harmful? No, on balance, it's been pretty good. And so there are new. So people can tend to resist change and that which is unfamiliar, but often those unfamiliar changes can be very beneficial to us, to all of us. And so resisting them is natural. People don't like change. That's natural. People get frightened about extremes. Oh my God, we're in an AI bubble. Well, maybe we are. Or the other side of that is maybe it'll be like the internet, where 25 years ago, 30 years ago, really, before, I mean, Amazon went down, I don't know, 90% in its price, during the dot-com crash. And most people today would say Amazon's a pretty, beneficial company. You go on it, get what you want. It's there, quickly. You see what you're paying. If you don't like it, you can return it, no questions asked. I mean, if people trust it. And so that part of the internet has been terrific for people and, made life a lot easier. You don't have to drive places and expose yourself to the risk of driving around to get what you need on a day-to-day basis. It's pretty cool. And that could be, we could have an exponential increase in the way we do things just with this AI stuff. And the reality is, I mean, AI has been around for a long time. It's just been in the background. It's just now it's coming to the front of people's minds because of these applications like ChatGPT or Claude or others. So people are seeing it. But I happen to think what's going to happen in the future. I'm very positive about the future. Does that mean I think the stock market's going to go up more than 10% a year forever? No. We're going to have years where it doesn't grow at all. In fact, where it could be down. But, those will probably be temporary, as they have been for 100 years. So
Mm.
I'm
Yeah,
just,
I feel like humans really like that predictability. They like to see forward momentum, and which I guess takes me to my next question is what role does patience play in the wealth building industry? Because I think most people overcomplicate investing simply because they don't understand it. I know for me, my brain isn't a math brain, and I know when I learn about something at first, it seems overwhelming. So I think for most people, it's just they overcomplicate what it is. Um, so is it possible that consistent strategies outperform most people that are trying to beat the market? And then what role does patience play in all of this?
well, first of all, you said something to beat the market. Okay. You don't have to beat the market to do well with your money. Okay. If you
Mhm.
just match the market, you can do very well. And those numbers I gave you were just the market return. Those were not anybody beating the market. Now, I will tell you straight up, I mean, I was in an industry where that was our goal, is to find people that could beat the market for our clients. And on balance, we did. That's a full-time job. Okay. That is a full-time job. There's nothing easy about it. Yeah. So just because you find a fund that has done really well for X years doesn't mean it's going to do really well for the next X years. Okay. In fact, it could go the opposite way. So there are all kinds of factors that get very complicated in terms of beating the market. But what I say to people is, like, if you buy the market, and again, this is Warren Buffett's advice really forever to people. And this is not what he does personally and professionally, because he picks individual companies and he's done it really, really skillfully. But he's also been very patient, and he's also been willing to step in when things don't look very good. Okay. And he did that at the crisis in 2008. He stepped into a horrendous, market crash, and he put money into institutions that helped them survive. And he came out of it pretty well. We all did. So, it's very important to understand that you have to be patient. I guess the one thing I would say is, you don't have to be a math wizard to be a good investor. You said, you're not good at math. Well, some people are brilliant, some people aren't. I'm not especially great at math, and that's one of the cool things about AI, because I don't have to be now. I can just ask AI to do a spreadsheet for me, and it does the calculation in a heartbeat. And a matter of fact, one of the things you can control, which we haven't even touched on yet, when you invest money, is to control your expenses of investing. That's the one
Mhm.
thing you can control with 100% certainty, is your expenses. So people who hire advisors or wealth managers, have to understand that they should be getting a return from that wealth manager after the fee compared to a market index return, which they can get for essentially no fee. It's 0.03% to be in a market index. And there's nothing wrong with doing that. And there are plenty of academicians out there that have, over the last 50 years, basically have proven that it's a smart strategy. Because when you buy an index fund, you're getting all the losing stocks, but you're also getting the gainers too, the winners. And you're also getting the decisions of all those managers out there. They're getting paid a lot of money to pick those stocks, as well as the decisions of people who are picking them without getting paid to do it. Okay. So it's a very kind of democratized approach to investing. You're kind of getting the decisions, the good and bad decisions of everybody. But the bottom line is the returns have been competitive compared to managed money. And that's just a fact. And you can try to pick, to beat the market with picking a good fund or ETF or what have you, or doing it yourself by picking stocks. And maybe you can. And as I said earlier, I'm all, my hat's off to you. Great. You should do that. If that makes you feel good and you can do it, you should definitely do it. And oh, by the way, that could make an enormous difference in your compounded returns too. The one thing we haven't talked about so far, that's aside from fees and expenses, which you can control with certainty, is understanding compound interest. And so I talked a little while ago about the return on $1 million from March of 2009 until just recently would have turned into $12.5 million. If that had been managed by a wealth manager charging 1% a year, but only matching the market, okay, before the fee. So after the fee, they were getting less than the market. That would have cost $1,600,000 plus for that, to pay that fee to that manager for those 16 years. So yeah, it's a big, big number. And that's the one thing the wealth management industry doesn't really tell people. Because it's not just you say, but Andrew, it's you're only paying 1% on the million. That's 10,000 a year. Yeah, that's the first year. But by the end of the time, you were paying, at 1%, you were paying $120,000 a year because the money had increased in value. And oh, by the way, if you're paying that 1%, the 1%, you were losing the earnings on that 1% every year for those 17 years. Oh, it's only 1%. No. So understand compound interest. And there's a calculator on my website that takes literally 30 seconds to do. You don't have to put an email in, and you can put your investment value in there. You can put the number of years you're going to want to be invested. You can put your return that you think you will make, call it 7%. That's a reasonable estimate for people who are invested in stocks and bonds. And most people could do more than that, but call it 7%. And then whatever fee you're charged of 1%, it'll show you exactly what the difference is between the return with the fee and without the fee. And it does all the compounding calc. So you don't have to know math. It does it for you.
Mm-hmm.
And I'm just trying to keep it. And as far as I know, it is the only fee calculator out there that's like that. There's some others out there that get very complicated and they put tax rates in and inflation rates and all kinds of other variables. No, keep it simple, guys. Keep it simple.
Yeah. Simple is the way. Yeah, for sure. So this is the part about investing that is tough for people, which you already touched on. That's the emotional side. And so it's really challenging for most people to stay calm when things start dropping. So do you think that emotions cause more damage than bad investing decisions, or what is your take on that?
Well, I think emotions make people susceptible to making bad decisions. Yeah, absolutely. Absolutely. And it's kind of like, I mean, we both live in climates where the roads can get pretty slippery. Okay.
Yeah.
And I don't know if you've ever been on a road that gets slippery and your car starts going in a direction you don't want it to go in. And the instinct is to steer in the opposite direction. That's your instinct. Oh my goodness, I'm going left and I want to go straight. So let me turn the wheel to the right. No.
Oh yeah, I made that mistake before.
No. But you know as well as I do that if you stay calm and you say, okay, I've got to I can't make any radical changes in the steering wheel because then the car is going to get up, the balance will be upset. So the best thing to do is just kind of go with it and slowly get out of it as you slow down. And that's kind of the way you have to think about, making a decision under stress. You cannot make decisions under stress or when you're in an emotionally heightened state because you're going to make a decision you might not make if you were not in that state. And I think most people can understand that. I'm not preaching to people. I'm just telling you my experience in life. It's like you got to stay
Mhm.
cool, man. You just don't start getting squirrely when things are challenging you. Just stay steady.
Absolutely. So we talked about the market, the way the market has been behaving over the past 15 plus years. For someone listening who feels like they might have missed the run, what would you say to them?
Well, I'd say, yeah, you did. You definitely missed it. All right. That's assuming you could have invested in the past. Okay. It's just the reality of it. All right. So where does that leave you now? All right.
Yeah, is it
Well,
ever too late?
all right. First of all, the most important thing you can do when you invest in something as uncertain as the stock market, and it's not certain, it's an uncertainty, is to have a long enough time horizon to allow you to take advantage of the benefits that a stock market can offer over time. So, what's the minimum time horizon for people? Well, if you're talking about 100% of your money, then it's probably 10 years. If you don't have 10 years, in other words, what could happen? What happened, let's say, in the dot-com crash? If you were in the market in March of 2000, the market started going down. It went down for 2.5 years. It went down 50%. And it had years during the next 9 years where it did come back. But the bottom line is for a whole 9 year period from March of 2000 until June of 2009, the market was down about 30%. Okay. So that
Mhm.
was almost a decade where you lost money, okay, from start to finish. And that could happen again. Now, if you stayed in the market after that, we all know what happened because we've just talked about it. Okay. From 2009 forward, it's been terrific. So the first thing I would say is you have to have a long enough time horizon to be investing in stocks. Now, if your time horizon, if you need that money within the next, 10 years, you can't invest it all. So you have to keep enough money aside or in safer, more stable investments like intermediate term bonds, treasury bonds in particular, or treasury notes actually. And there are ETFs that'll do that for you. Then you can say, well, all right, you have to calibrate it to your own tolerance for risk, which is again that's what I do professionally. I mean, I help people figure out what is their risk tolerance, what is the appropriate level of risk they could assume, and then it also will project out returns. So here's what's likely to happen over the next X months. And in my case, we do it over 6 months and then longer. Here's what's likely to happen over. So if you're going to be retiring in 20 years, we look at what's going to happen between now and 20 years. What's the most likely outcome? And it has a range of probabilities that you will likely experience. And that's just based on historical returns, which are nothing more than people's actual reactions in the past to extremes in the market. So you're looking at you know, what did people do when, over this long period of time? And it shows you the pattern of returns. And so basically what it'll do, it'll help you. And so maybe you can't have 100% in stocks. Maybe you can only have 30% in stocks or 50% in stocks. And it will show you what the downside risk is for that portfolio. And if you can handle that, great, then that's what you do. If you can't, then you have to change it. The other side of that story is for people who, oh my goodness, I missed it. I don't know what to do, but I'm still got 20 years to go before I retire. I will tell you this story. I had somebody fill out this risk assessment on my website, which does require you to put an email address in, and it comes up with a score. And the risk scores go from 0 to 99. And the market, the Standard and Poor's 500, is about a 72 risk. And this person came up with their preferred risk was 68. I thought, okay, well, that's, pretty aggressive, but okay. And then I looked at the portfolio that this person who was about to retire, actually 65, I looked at the portfolio and the portfolio risk score was 38. And that meant for that individual that that individual did not have enough risk, because that in that case, this person forfeited about $1.5 million in opportunity on what more recently was like a $3 million portfolio. The portfolio would have been $4.5 million if they had calibrated the risk that they said they wanted, 68 risk. Okay. So that's the other side of the story. You have to be, you don't want to take too much, but you also don't want to take too little. So, and I know this is complicated. And it's like, what's this guy talking about? That sounds like a lot of baloney. Well, okay, I'm sorry you feel that way, but that's just the reality. So I'm not an apologist for the stock market, for starters. I'm not cheerleading to invest in stocks. I'm not apologizing for what it's done. I'm just saying that's the reality, guys, and that's what we have to deal with.
And so then what mindset should people be carrying into this next phase of the market that's about to be exposed?
Well, again, they should understand, they should have a very clear idea of what their tolerance for risk is. And I'm not predicting anything in particular. I'm not predicting a market decline, and it could happen at any time. But I look at with client people who have engaged us with 6 month horizons. Here's what could happen over the next 6 months with 95% probability. That's pretty high probability. Now, is the range not? No, the range is not narrow. It could be, it could be 15 or 16 or -8 or 9. And when the average of that might be 5. But that's just an average. That's just a mean. It could be, and who knows, it could be worse than that or it could be better than that over the next 6 months. But the whole point is what you do is you should have a really clear idea of what your tolerance for risk is before you exceed it. Because the worst thing that can happen is, okay, I go in there and I feel really good about this and we're going to do really well. And 6 months later, you're down 20%. Oh my God, what am I going to do now? This is terrible. This doesn't work. What should I do? Well, if you knew that there was a pretty good chance it could do that to begin with, you wouldn't have done that. You would have scaled it back. You said, well, okay, I don't want to take risks that will expose me to a 20% decline. I'll take risks that will expose me to maybe a 12% decline. So, and there's no guarantee that those numbers are going to be materialized anyway. They may not materialize, but at least you're going through a structured, logical, rational process to determine your own likely behavior. Okay, when you are tested, not if, when you're tested. Okay, and you will be tested. The stock market will. And the thing is, it's not just individual sort of investors. This happens to professionals. It's not easy for anybody. Okay, and if they and unfortunately, I talked to people. I met a gentleman this morning at a class I was taking, actually on AI, that he said, "Well, I'm addicted to CNBC, the financial news channel." I'm thinking, uh-oh. I said, oh, okay. Just be careful because, and what happens in those cases, I've seen people interviewed on those shows whom I've known, I've met with, face to face in business, and that are managers, hedge fund managers and other kinds of managers. And, they sound really smart and they always sound super smart. And they always are very confident about what they're saying. And they typically are making predictions. But the first thing I would say, if somebody's making a kind of a single point prediction, this is what's going to happen in the next 2 months or week or whatever, year, I would be very careful about believing that because I've known enough of these folks to know that they're not that good. Nobody's that good. There are only a few people that are that good. And the other thing about those shows is the people that are being interviewed, so they're on today. Let's say they have a view today that's positive, or let's say they have a view today that's negative. And then next week, the market is a lot lower. Well, they may not be interviewed by that news station, and they may change their mind, and they may get very positive after the market's gone down a lot. And you're not going to know that. So just be super careful about these kind of short-term predictions, or even year or 2 year predictions, because people just don't know what's in the future. We don't know what's in the future. What if the price of oil goes to $200 a barrel and stays there?
Right.
What kind of adjustments will we make then? Well, it'll be good for some folks. It'll be not very good for others. Probably the majority of people won't be very good for the majority of people. So I'm just saying that, just be careful about, kind of emotional engagement, because it's this whole process that I'm talking about. Like, I do the most boring thing in the world. Okay. It's not fun. It's not exciting. The only time it's exciting is when it gets really good or really bad. But then the excitement is not the kind you want if it gets bad. And, so the best thing to do is just stay chill.
Great show. Well, thank you, Andrew, for this really great conversation. It taught me a lot about, the trending and what's to be expected over the next little while. Is there anything that we missed that you want to add before we go?
No thanks. No thanks, Lisa. I think, first of all, thank you for the really good questions. I hope we could improve you know, the views of your viewers, and add to their knowledge, and in their investment, Scott. The one thing I would say to people is everybody has an investment superpower. They really do. They really do. And the most powerful superpower there is to be patient. Know what to expect and be patient. And that's it. And that may not feel like the right thing to do for most of the time, but over the long haul, it is.
Well, thank you so much for being here. It was such a pleasure. And to our audience, thank you so much for being here. If there is one thing this conversation shows, it's that investing isn't about being perfect, it's about being consistent. So the people who will benefit the most from the market aren't the ones who time everything right. It's the ones who stay long enough to let it work. There's where that patience comes in. So, Andrew, this was such a great reminder that sometimes the most powerful strategy is also the simplest. And for everyone listening, whether you're started years ago or you're just getting started now, the question isn't, did I miss it? The question is, am I willing to stay in the game long enough to win? Thank you, everybody, for being here. Stay tuned for the next episode coming soon. We'll make sure to have Andrew's information in the show notes so you could have access to those calculators he was talking about, and you can learn more about what he does from his website. Until next time, take care, everyone.